Yesterday, the Government Accountability Office, the nonpartisan investigative arm of Congress, released its annual audit of the U.S. government. The report covers the fiscal years 2011 and 12. The conclusion of the report is this, quote, absent policy changes, the federal government continues to face an unsustainable fiscal path. Let me repeat that. Absent policy changes, the federal government continues to face an unsustainable fiscal path. If the feds do not stop the wild spending and do not reform Medicare and Social Security, the U.S. dollar will collapse. That means that all of our savings, all of our investments, our homes, and everything else will blow up before our eyes. Now, chances are you will not hear about the GAO's report today, except on this program. The liberal media will not tell you what is going on. The reason? President Obama does not want to cut federal spending or reform entitlements. That is crystal clear. And the media loves President Obama. So the folks be damned. This is like telling people standing on a beach, hey, a tsunami's coming. And if you don't move, you're going to be killed. But the beach folks say, I like it here. I'm not moving. And then eventually the wave sweeps them away. That's exactly what's happening now. We're living in a country that's polarized. We're also living in a country that is becoming addicted to machines, the internet. We discussed that last night. Many American citizens, perhaps most, are now too lazy to pay attention to their country. They're selfish, caught up in individual pursuits. Thus, the federal government has been allowed by we the people to get out of control. Last year, the Fed spent $1.1 trillion more than the government took in. That is grossly irresponsible. The debt now approaching $17 trillion. President Obama, the biggest spending chief executive in history. So, I have to play Paul Revere here. I have to continue to tell you the truth. But I also believe many Americans simply will not listen. And even worse, they are not smart enough to even care. Disaster could be coming.
You want to weigh in on gold, so to speak?
Yeah, Joe, I heard what you said at 7 o'clock, but the $5,000, it's not just some pie in the sky forecast. It's actually very simple math. Take M1, which is about $1.5 trillion. It varies a little bit. Take the U.S. gold supply, which is a little over 8,100 metric tons, and just do the division. You come out with a number of about $5,000 an ounce. In other words, when we have the sequential collapse of currencies, paper currencies, and the U.S. has to go to Plan B, which is the gold standard, you have to peg it at a non-deflationary level. The problem with the gold standard in the 1920s was not the gold standard itself. It was that they pegged it at $20 an ounce, which was the pre-World War I price, which was highly deflationary. Pegging it at, say, $50 an ounce in 1925 might have helped prevent the Great Depression. So when we have to go back to gold now, it's really important not to peg it too low. So there's a range depending on how you do the math and whether you want to use M1, M2, but that range is between $5,000 and $11,000 an ounce. So it's not really a forecast. It's simple math. It's where we'll end up once the dollar collapses.
What do you think, Tim?
Wow. It's amazing to think that that's the number we're talking about.
I just, won't that be, since there is a relationship to gold and like a barrel of oil or a suit, is it going to be $5,000 to buy a nice suit?
Well, it'll be 1 ounce of gold. That's actually the right way to think about it. I don't think gold is going up. I think gold is fixed. What we're seeing is the collapse of the dollar, and we're actually starting to quote the dollar in terms of units of gold. So right now we're at about 75 10,000ths of an ounce. It's like 0.00075, and so you can think of the dollar sort of going from 75 down to 73 down to 70, etc. It's really how many ounces of gold do you get for your dollar? That's the right way to think about it. So this isn't really a rally in gold; it's the collapse of the dollar.
All right, Tim. Thank you. Appreciate that weighing in on both subjects.
I want to show the boom-bust cycle in terms of what's happening relative to stocks, overvaluation and undervaluation against major stock indices, and explaining why we still have a ways to go in this current bust. As I was saying earlier, it won't end until 2013, 2015. This is the Dow Jones Industrial Average in terms of gold, and it shows the boom-bust cycle, and you can see clear cycles, the boom, the bust, boom, bust, boom, bust. Now, what's happening in the United States is not unique. Go ahead, David. This is I don't have the data going back to 1913 when the Federal Reserve was created, but this is the FTSE, the London stock average in terms of gold, explaining the boom-bust cycle. Go ahead. And that's the DAX. We live in a global economy. What banks do in the United States, they do all over the world. They lend and lend and lend, create the boom, create the illusions of prosperity. Too many loans are made, too many debts are borrowed. Banks become over-leveraged, debtors become over-leveraged, and you go into the bust. And when you're in the bust, you want to avoid financial assets like this. You want to move into tangible assets like gold. Okay. I just want to summarize real quickly, the current situation. If you were here a year ago, January, when I spoke at the DHU event in this particular hall, I made some key points, and I showed how the gold's what I call the exchange rate. It's not the price, because you don't talk about the price of Swiss francs, you don't talk about the price of yen, you talk about the exchange rate. Gold is money, so you talk about gold's exchange rate relative to other currencies. It's rising against the dollar, rising against the euro. Okay, David. Commodity and oil prices are rising. They were rising back in January 2010 when I was speaking there. They're even rising more now, both in dollar terms and euro terms. Negative real interest rates. If you put 100 euros in the bank on January 1st, you might get 101 euros on December 31st, but the purchasing power of those euros are probably 92 euros based on the true inflation rate of what's happening in commodities and goods and services. Blind faith in central banks. Why do we believe the Federal Reserve? They have such a lousy record. I mean, Milton Friedman wrote a book in 1965 explaining how the Federal Reserve made the Great Depression worse by their manipulation and attempts to do it. Yet we believe when Mr. Bernanke says he can fight inflation in a minute or take away the punch bowl, the punch bowl is continually being filled by the Federal Reserve. They're not fighting inflation. They're bailing out the banks. Quantitative easing is pushing up stock prices. Stock prices are not rising around the world because of good economic conditions. You can't have good economic conditions until employment starts improving. Spain reported today 21.4% official unemployment rate. That's a Great Depression type of a number. The unofficial employment rate, they tell me, and I live in the south of Spain, is closer to 34%. Runaway government spending. This is the key. Of the 16 countries in the European, in the Euro bloc, 13 of them are violating the 3% rule. We've got runaway spending all over the world. And what happens is when a government is spending too much and the market is unwilling to lend money to the government turns to the central bank and the printing press. During the Weimar Republic here in Germany, the Weimar government was spending too much money. They turned to the Reichsbank. The Reichsbank ran the printing press, and we ultimately had a massive hyperinflation with wheelbarrows. The reason why you had wheelbarrows and paper all over the place is that Germany at that moment in time was a cash currency economy. Most transactions were done on the basis of cash. In contrast, in Argentina in 1991, where I went to study what was going on in hyperinflation, you had a deposit currency economy. Most commercial transactions took place through the banking system by checks, wire transfers, plastic cards, and the like. And what happened in Argentina, when the Argentine government was spending too much, the central bank bought the debt that the government was borrowing. Nobody was willing to lend, and they added zeros to the Argentine government's checking account, which it then wrote checks against and created a hyperinflation. The U.S. is headed toward an Argentine-style hyperinflation, and I think we're getting very, very close. I don't know if you've been following the dollar index, but we're very, very close to its all-time low. And I've been discussing on King World News, which is an internet site, why the waterfall decline that I've been talking about in King World News began after Mr. Bernanke's press conference the other day when he was talking about quantitative easing. Everybody understands that runaway government spending in the United States is leading to hyperinflation, just like it did in Argentina in 1991, just like it did in the Weimar Republic in 1924. And lastly, I had question marks when I gave this presentation back in January 2010. The demand for currency is as important as the supply of currency. Everything in our world of economics has supply and demand, even money. And the key to understanding what's happening to the dollar and the various paper currencies or fiat currencies around the world is not so much what's going on in the supply side, even though the supply is increasing. It's what's happening on the demand side. The demand for the dollar is falling. Confidence in the dollar is falling, and it's going to continue to fall because people who are looking at the situation in the United States recognize that Congress is spending money with no discipline. The Federal Reserve is buying that debt and turning it into currency. And let me give you an example. When the Federal Reserve announced quantitative easing back in August of 2010 to the present, the U.S. government debt has increased to about $900 billion. Think about that, $900 billion. Over $500 billion of that was turned into money by the Federal Reserve. That's what makes hyperinflation. That's why the dollar is falling. That's why gold and silver are soaring. Okay, David. I want to wrap up with 4 charts. You may have seen an article that I wrote recently about this. I got a lot of criticism because I'm not a mathematician, and I called it hyperbolic rather than parabolic because this is a log scale chart. In other words, the distance between 250 and 500 is the same distance between 500 and 1,000, so you can easily measure percentage changes on this chart rather than if it were an arithmetic scale. Anyway, the point that I want to make is that the precious metals are getting ready to explode, and in fact, they've already begun. The dollar's begun a waterfall decline. Precious metals have begun an explosion. And I want to show the price of gold in terms of 4 different currencies. Now, we all know that the price of gold is rising in terms of U.S. dollar. I mean, it's getting ready to explode to the upside. David? The price of gold is rising to the British pound. Note the similarity between the dollar and the British pound chart. Now, it's a good thing everyone's sitting down because, David, let's have the next one. This is the price of gold in terms of the euro. There's no difference between the British pound, the US dollar, and the euro. And the next one, David? Even the Swiss franc. It's exploding against all of the different currencies. What we have here is a historic moment. What we have here is a lack of confidence, a flight out of the US dollar, a flight out of all of the paper currencies of the world. People understand that the game is up. The ability to create money out of thin air with no discipline is coming to an end. And it's going to end in an ugly way unless you own gold and silver to protect yourselves. Ladies and gentlemen, thank you very much.
Thank you very much, Stephen. I'd like to call upon Nick Bereshef, please.
Thank you. Good afternoon. It's a pleasure to speak once again at the Investment Outlook for 2012. Today, I'd like to focus on one important idea: the direct relationship between the rising price of gold and the rising levels of government debt that result in currency debasement. Since we measure investment performance in currencies, a clear understanding of the outlook for currencies is essential. In order to understand gold's relationship, it's important to understand that gold is money. It's not simply an industrial commodities like copper and zinc. It trades on the currency desks of most major banks, not the commodity desks. The turnover at the London Bullion Marketing Association is over 37 billion a day. The volume is estimated at 5 to 7 times that amount. Clearly, this is not jewelry demand. The world's central banks know gold is money. After decades of modest sales, they have become net buyers since 2009. This trend strengthened in 2010 and gained further momentum in 2011. They are buying gold as a counterbalance to their devaluing currencies. As money, gold has provided the most stable form of wealth preservation for over 3,000 years. It still does today. Gold has outperformed all other asset classes since 2002. This chart clearly shows that the U.S. federal debt, which is in purple, and the price of gold are now moving in lockstep. The red line represents the repeatedly violated government debt ceilings. This correlation is likely to continue for the foreseeable future. Based on official estimates, America's debt is projected to reach $23 trillion in 2015. And if this correlation remains the same, the indicated price of gold would be $2,600 per ounce. However, if history is any example, it's a safe bet that government expenditure estimates will be greatly exceeded, and the gold price will therefore be much higher. And it's not just the U.S. Most Western economies have reached unsustainable levels of debt, and that will be impossible to pay off. It's worth noting that the U.S. Federal Reserve, unlike the European Central Bank, can create money without restriction. The U.S. dollar has been the de facto world reserve currency for over half a century. The rest of the world currencies are essentially just derivatives of the U.S. dollar. Whether global debt is in euros or special drawing rights issued by the IMF, the Fed, and thus indirectly the U.S. taxpayer, will become the lender of last resort. Now, there are four possible ways to deal with this unsustainable debt. One is to grow out of it through increased productivity and increased exports. This is highly unlikely, as Western economies and even China are poised for recession. Two, is you can introduce strict austerity measures to reduce spending. This has the unwanted short-term effect of increasing unemployment, reducing GDP, and resulting in even higher deficits. Number three, you can simply default on the debt. This will make it difficult, however, to raise future bond issues. And number four is to issue even more debt and have the central bank in question simply create whatever amount of currency is needed. Most politicians will select option four, since few have the political will to choose austerity, cutbacks, and full economic accountability over simply creating more and more currency. Inevitably, they will choose to postpone the problem and leave it for someone else to deal with in the future. Last August, the world watched as the U.S. government struggled to come to an agreement on raising its debt ceiling and was forced to compromise and delegate the final solution to a supercommittee. Its lack of political will earned the country an immediate downgrade from the S&P, and subsequently the hastily convened supercommittee failed to reach a solution as well. In Europe, matters were even worse. Greece did try to write off half of its debt, but Germany and France reminded them that if they did, no one would buy their bonds. The British and the Irish implemented austerity measures that raised unemployment, reduced GDP, and resulted in even higher deficits. Italians watched their bond yields rise to 7%, while the tsunami and related nuclear incident deflected attention from Japan's financial problems as a temporary low, because Japan has the highest debt to GDP of any of the developed countries. In order to compensate for slower growth, governments attempt to devalue their currencies and thus improve export competitiveness. This can lead to a global currency war that author and Wall Street and sort of Washington insider James Rickards discusses in his best-selling book, Currency Wars. The process is now well underway. A recent Congressional Budget Office report predicted that the U.S. federal government's publicly held debt would top an unsustainable 101% of GDP by 2021. Currently, the official U.S. debt is an astronomical $15 trillion. Yet this is only current debt. If the U.S. government used the same accrual accounting principles that public companies must use, unfunded liabilities like Social Security and Medicare make the real debt more than $120 trillion. This represents over $1 million per taxpayer. Obviously, this amount is impossible to repay. It's interesting to note that in almost every recorded case of hyperinflation, a point where inflation exceeds 50% a month, was caused by governments trying to compensate for slowing growth through full throttle currency creation. This is exactly what we're seeing today. These events gave me the confidence to title my new book, $10,000 an ounce gold. The book connects the many trends that will be responsible for both rising debt and rising gold prices over the next 5 years. It'll be published later this year. To make matters worse, the irreversible macro trends that I discussed last year are still very much in place today. These include the added cost of retiring baby boomers, systemic unemployment due to outsourcing of Western jobs through globalization, and the rising oil prices due to peak oil. These irreversible trends will increase unemployment, lower GDP, reduce tax revenues, increase deficits even further, and force governments to borrow ever-increasing amounts of money. Governments find themselves between the proverbial rock and a hard place, as even austerity measures tend to negatively impact GDP. As GDP falls and debt increases, credit downgrades are likely to follow, resulting in higher bond yields, followed by even greater deficits. It becomes an unstoppable descending spiral. The loss of purchasing power against gold continued unabated last year. The US dollar and the British pound have lost over 80% of the purchasing power against gold over the past decade. The yen, the euro, and the Canadian dollar have lost over 70%. As we remind our clients, this is not a typical bull market in gold. Gold is not rising in value. Currencies are losing purchasing power against gold. And therefore, gold can rise as high as currencies can fall. Since currencies are falling because of increasing debt, gold can rise as high as government debt can grow. The sovereign wealth funds, as well as the more conservative central banks, will have little choice but to reallocate to gold in order to outpace currency depreciation. This is why some central banks, particularly those of China and India, accelerated their gold buying in 2011 for a third year in a row to nearly 500 tons, about 1/5 of annual mine production. While central banks have been net purchasers of gold since 2009, the real game changers will be the pension funds and insurance funds, which at this point only hold 0.3% of their vast assets in gold and gold mining shares. Continuing losses and growing pension deficits will make it mandatory for them to eventually include gold, the one asset class that is negatively correlated to financial assets such as stocks and bonds. When this happens, there will be a massive shift from over $200 trillion of global financial assets to the less than $2 trillion of privately held bullion. In considering where gold will be at the end of 2012, I look back to my first Empire Club speech in 2005. I said then it didn't really matter whether gold closed the year at $400 an ounce or $500 an ounce. The trends were in place to ensure it had much further to rise. 7 years later, we can say the same thing. It doesn't matter whether gold ends 2012 at $2,000 or $2,500, because gold's final destination will make today's price seem insignificant. These can be frightening times, but gold always offers hope. We may not be able to change global economic problems or government debt, but individuals can protect and even increase their wealth through gold ownership. Now, gold bullion ownership, not mining shares, ETFs, or other proxies of ownership, is insurance against accelerating currency debasement. We use the analogy that in case of a fire, would you rather have a real fire extinguisher or a picture of one? A number of people have approached me recently and said they wish they had listened 5 years ago. They feel they've missed the boat, that it's too late to buy gold. For those that feel that way, let me close with a Chinese proverb. The best time to plant a tree is 20 years ago. The second best time is today. Thank you.
Hello, I'm Greg Hunter. Thank you for joining us today on USAWatchdog.com. With us once again, Gregory Mannarino. Of course, he's the former floor trader for Bear Stearns. He did that in the early to mid-90s. He is a financial analyst. He is also hires himself out as a research consultant for big Wall Street banks. He has his popular GregoryMannarino.com and Gregory Mannarino YouTube channel, and also his newest channel, TradersChoice.net. Gregory Mannarino, glad to have you on USA Watchdog.
Greg, I'm always happy to be here. Thank you so much.
Good to have you here. I just want to get right out of the gate here, and this story kind of flew under the radar in most places, but a few weeks ago they were talking about stopping the QE, and now they're talking about extending QE, and this is what you've been saying for at least as long as I've known you. What say you?
Without a doubt, this can't stop. There's no way. I think what goes on here, and it's really sad the way they play this out, is you have, like, let's say someone coming out here from the Federal Reserve stating, oh, we're going to cut back on QE, we're thinking about doing this, and then we hear the polar opposite, which just came out recently being reported by Bloomberg. Why do they do this? Honestly, there's a mechanism behind this, Greg. They try to keep people off balance. They want to keep people confused. It's all part of this game that is being played against the people. The Federal Reserve, this is no secret, has become the lender of last resort. They cannot and will not ever stop this money printing scheme into oblivion, and I literally mean into oblivion, until we hit that wall and this entire thing comes apart here. That's the way I see it unfolding. I can't imagine another way. Because the next crisis here, Greg, and I think that people are too focused here on the equity markets, is going to be a crisis of currency. And which is going to wipe out everything else. It's all tied together through very complicated financial instruments called derivatives. You're familiar with that. I think a lot of your listeners are as well. But what really needs to be kept in mind here and at the forefront of everybody's thinking process is there's no way out of it. The Federal Reserve cannot and will not stop printing. If they do, it is party over at that moment.
Is this why we're seeing this big rush into physical silver and gold? I mean, a lot of reports. My friend, I have a really good contact who's been at a coin dealer. He was a coin dealer since the 70s and says he can't get silver. He can still get gold, but commissions are rising. Is this what this is a move towards? I mean, it got whacked down. Everybody said, wow, it's on sale. I mean, that's kind of backfired if they were trying to kill the price and kill the demand. It's backfired.
Well, there's a lot to it that's going on here. But, again, we're in a currency war. You and I have spoken about this. I've talked about it so many times. And this is the world central banks trying to devalue their currency. This will not stop. Again, it all plays in together about what's going on here. The world central banks, they will not stop. They cannot stop. for many, many reasons that we've gone over. Let me just show you this for your listeners and watchers. We've been hearing a lot of the talk about gold and silver and the spanking that it's taken. Really? Well, how about this? This is the U.S. dollar index since 2003. This is what it looks like. This is what's happened to the U.S. dollar, Greg, and for everything else. Yeah, it's not good at all here. And you can see we're right now at the top of the trading range. I called every one of these tops. And I went short, and I'm telling people they should be looking to get short right here. There's going to be a lot of cash to be made. But let's just do something else. Okay, this is the U.S. dollar index since 2003. Let's look at gold. Ah, yes. Which one would you rather be invested in, Greg? Or anyone else watching? I mean, come on. This is absurd. This is the pullback we've had now. But, let's forget about all of this. Let's just focus on that. That's what the mainstream media wants us to do. This is absurd. Again, what is going on now it's multifaceted, but if we put a perspective on it and say, okay, we have prices now with regard to the spot of gold and silver where the miners will not mine. They will not mine. There's going to be shortages, something, again, I've gone over since day one, how this would unfold. This is no surprise here, what's going on here with the spot price. Anyone that's followed my blog or my work, or even in my book, The Politics of Money, I outlined how this was going to play out. Everything is going right along that game line or this play line. And really, you don't have to be psychic to figure this out. This is just very simple mathematical equations, period. And there's only going to be one conclusion, Greg, and it's not going to be pretty.
Is the middle class going to get wiped out? Are we heading towards some sort of have and have-not feudal system?
100%. Well, absolutely. I've outlined this before. That is exactly what is going on here. We're going back in time to a feudal system with two-tier society, the haves and the have-nots. Middle class, gone, finished, wiped out. And those are the ones that make it through this, Greg. I mean, I think a lot of people lose sight of what is really happening here and what has been relentless since 1971. Here in the United States, and since we officially went off of a gold standard here, we've seen the debt literally skyrocket. What has happened because of that is we've created an alternate reality. We've borrowed cash from the future to live a better now. And what has that done? That has created a population boom. And if you watch the debt, and if you watch the population, they've risen in tandem. So let me ask anyone who wants to reply here, when the debt bubble bursts, and it is the biggest bubble that has been created in the history of the world, and the world population has followed that in tandem. When that bubble bursts, what's going to happen to the population? I'm going to tell you, it's going to correct. Millions of people are going to get wiped out here, Greg. And I don't mean just on a financial level. They're going to lose their lives. Why? Because of resources. Right now, we're seeing what's happening to gold and silver. These are finite resources that are going to become scarce. There is going to be a mania in these metals that people are not going to believe because they're going to get away from this Ponzi scheme of currency, and they're going to rush into metals because they're real assets. And unfortunately, that's going to cause